So for those stocks that you own, how should you be prepared to react? So you make the determination, all right, I'm gonna hold this stock into earnings, or maybe another strategy might be to take partial profits. Maybe you don't go in with a full position into earnings. Maybe you lock in half of that gain. So how should you be prepared to react when that report comes out? The expectations are often very high for these high profile tech stocks. So a beat or miss could really have an impact on the price action.
Well, in general, I think it's a good idea to wait at least a few minutes after the open. I mean, if a stock crashes 20, 30%, I mean, you can wait a few minutes. It doesn't really matter. You probably want to be getting out in that situation, especially if you're a recent buyer. But in most things, if it's up 5%, down 5%, wait a few minutes because the market will often have a big reaction right at the open and then change direction. So just try to keep your emotions in control. And that's always a good idea. Try to keep your emotions in control. Try to think about a lot of this at night or over the weekend. Make a lot of your planning. Try as much as possible to let your emotions out. The market is going to have a lot of emotion, but you should try to stay just rational as much as possible. Easier said than done. It's easy for me to say that, not as easy for me to do it.
So, say stock does move against me, I hold it into earnings. Why shouldn't I just hold and hope for the long run that it's going to recover? It's Apple or it's Google. Isn't this thing eventually going to come back?
I mean, look, a lot of them will. A lot of them will. I mean, so you can get away with it. But for one thing, sometimes they do not. I mean, just flat out. Sometimes they're not, or they're down for a long, long time. Some of these stocks, like Microsoft, I think it peaked in 1999. It took a decade for it to come back to those old highs. You know, now looking back, sure, would you have made it? Yeah, that would have been fine in that regard. But you're also
But
missing
decades
out.
of dead money,
Dead
right?
money. You're right. So it may never come back, and it's maybe months or years of dead money when you could have been buying something else. So even if you end up winning from that, you may not really be winning. You could have gotten out and moved on to something else. And, psychologically, it can be a relief just to get it out of the way. It's like it's done. I took my loss. Now I can move on rather than just have that weighing on you psychologically. It's almost worse than the loss itself.
All right. Well, now let's move into some historical examples of maybe some extreme scenarios of what can happen. You can see my chart, but for those listening to the audio version of this, we will explain what we're seeing here. So, right now, I've pulled up a chart of Twilio, an enterprise software name that maybe many of you out there are familiar with, the ticker TWLO. And in the quarterly earnings report in May 2020, this stock had a huge positive reaction to that report, with shares gaining some 40%. So, Ed, walk us through the thinking here. Maybe this was just one on your watch list, or maybe it flew under the radar. Maybe you didn't have all of those fundamental and technical factors in place ahead of the report, but boy, afterwards, it looked like that was a great buying opportunity.
Yeah, I mean, sometimes like this stock had sort of been underperforming. It hadn't been doing that well. It had previously done well, but it had sort of been in a sort of a slump a little bit, just trying to come back, but it wasn't performing tremendously. But then that earnings, it just is a sort of, it was a game changer. I mean, it was a tremendous gain. And you mean, look, I did not take advantage of this. So I want to say, I'd love to say, look at me, I was so smart. And gap ups have their risk because sometimes they do pull back or they like, but they also can often suggest a real big move, that there is a fundamental mispricing, that the market is waking up and realizing this stock has a lot of strength. And this one went up 40%. And so you might think, wow, there's no way that can go higher. Instead, it just kept on marching higher, really big gain over the next few months. Yeah, it corrected then, but then it went again before finally, struggling a little bit, really nice move. And that's what you can get with earnings gaps. And it's just a character change. And it's definitely, it would have been hard to be ahead of it because you don't know. I mean, this was not one that was really crying out to be bought ahead of time, but you can buy it on the gap up and you can still get tremendous gains.
These earnings reports can definitely be a game changer. And let's also take a look at one that did not go so well. XL in X Xilinx. I'm going to go to 2019. So rewinding the clock a little bit more here with Xilinx. And this was tricky because it did have all of those great elements of strong earnings and sales growth. And in, let's see here, late January of 2019, had one of these big moves on earnings with the stock gaining 18%, what we call breaking out of a consolidation, went on a big run over the next quarter, but that doesn't guarantee you safety from a negative reaction the next quarter. And so then that's what we saw, shares plunging 17% on that next quarterly report and fell further from there. So this is one of those situations where holding and hoping could lead to even more losses, Ed.
Yeah, and it had this gap up, as you said, in January of 2019. It was one of the first stocks to break out. This is after there was a short bear market, and we're coming back. So this was a leader. This look okay. This is a given. This is boom. We're going. And probably could have held it, definitely could have held it into earnings because you had a big gain if you had bought it off the gap up. So perfectly understandable. But with that loss, you're wiping out almost all the gains, and it just kept on going. It just you would have if you got out there, you would have had a chance. Okay, you still took a profit. You still got out with a gain, even if you bought at the top of that earlier gap up. Holding and hoping instead, it quickly rolled over again. Yeah, it bounced back, but it was weak and it just kept on falling. So, that can happen. Even when everything looks good, all the momentum and the whole market did well. The market still did well. This was just Xilinx, and it was really disappointing for a lot of folks on this one. And that's what can happen.
That it was. And as you said, understandable to hold a full position into that quarterly report with a sizable gain if you did buy it right. But it does go to show how sometimes locking in even a partial profit with that earnings risk that's on the table can also be a good idea as well.
Yeah, and it's just really hard. There's always that question, do I try to go, do I go for a single or a double, or do I go for the home run? And it can depend on your conviction in the stock, and it depends on the size of your portfolio. If you're fully on margin, all in Xilinx, maybe you want to take some profits. If it's a tiny position, then that's a different story heading into it. So you have to balance out a lot of factors on how when to take partial profits and when to let it ride.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.